Hello. Welcome back to Gold Off the Charts. In this financial market full of uncertainty, competition, and fog, we don't chase surface-level excitement. We focus on what really matters underneath. Every day, we share a little deeper financial thinking, hoping to help you see a bit further, walk a bit steadier, and stay in the game a bit longer on your journey to growing wealth. In today's video, I'm not going to talk about boring technical indicators like overbought signals, candlestick patterns, golden crosses, or death crosses. In front of yesterday's market move, all of that was basically useless. Instead, let's look at what miracle really happened yesterday. Gold, the steady big brother we always talk about, suddenly acted like it had a shot of strong liquor and went completely crazy to the upside. During Monday's session, gold ignored gravity and shot straight up to a record high of $5,110.86 per ounce. Although toward the close, some people took profits and the price was pushed back near $5,000. You need to understand that the $5,000 level is still rock solid with strong buying support. By early Tuesday morning, gold started moving higher again, once gaining more than 1%, and is now hovering around $5,060. If you think gold is already wild enough, you clearly haven't looked at silver yet. Silver's performance yesterday can only be described in 4 words: absolutely heart-stopping. It was like watching a bungee jump in real time. During the New York session on Monday, silver once surged 14%, blasting straight up to a historic high of $118. But right after that, like a kite with a broken string, it dropped fast, giving back almost all of the gains and closing with only a 1% increase. Then this morning, it acted like nothing had happened, picked up momentum again, rose nearly 5%, and is now holding around $109. This kind of 1 second in heaven, the next second in hell roller coaster at such high levels is truly unprecedented. What does this mean? It means gold and silver have officially entered a new phase, a phase of extremely high volatility, extremely strong speculative emotion, but also unbelievably huge opportunities. At the same time, we saw a very interesting indicator, the gold to silver ratio. It dropped to as low as 44.09, the lowest level since 2011. I often tell you that the gold to silver ratio is like a thermometer for market speculation. When the thermometer explodes, it means the money in the market is literally burning hot. Facing such a crazy market, many of you asked me, prices have gone up so violently, I'm really panicking. Should I run or should I chase? What am I supposed to do next? Today, in this extra long deep dive video, I'm going to break everything down clearly and explain it to you piece by piece. We're going to answer 2 core questions. First, how should we really look at this so-called crazy bull market right in front of us? Second, in this new phase, how should retail traders adjust their thinking and reposition their strategies? Sit tight. This episode is packed with valuable insight and may completely change how you see the current market. Let's begin. First, we need to answer the first question. How should we view yesterday's sharp rise followed by a pullback? Many people see a long upper shadow on the chart and immediately feel nervous, wondering if this is a shooting star or a sign of a market top. Let me be very clear with you here. Don't let chart patterns scare you to death. On the surface, this extreme excitement does show that market sentiment is fragile, and even the smallest piece of bad news could trigger panic selling. But look carefully at today's buying support. Every time the price drops, buyers step in immediately. What does that tell us? It tells us that there is still a huge amount of cash waiting on the sidelines, lining up to enter the market. This kind of spike and pullback may look like normal profit-taking by bulls, but when you combine it with the chaotic global situation and the flood of institutional money coming in, my judgment is that the upward momentum in gold and silver is far from exhausted. We may even be in the process of building up for a much larger and more powerful move higher. Why do I say that? Because what is supporting this rally is not emotion, but 5 solid underlying forces as strong as steel. Let's go through them one by one. First, we need to understand why gold is rising. Is it because gold itself has become better? No, gold is still the same gold. It has not changed for thousands of years. The real reason is that money has become weaker. After surging 65% in 2025, gold has already risen about 15% so far this year, and the year has only just begun. This is extremely unusual in history. Behind this is a harsh reality. Global investors are losing confidence in fiat currencies. This is what Wall Street now calls the currency debasement trade. Look at the world today. Government debt is snowballing everywhere and growing out of control. United States debt is at $38 trillion, and Europe and Japan are also drowning in debt. How do they pay it back? Taxes? Don't make me laugh. They can't tax their way out of this. The only way out is to print more money and inflate the debt away. In other words, governments are openly taking money from your pocket, the market is not stupid, everyone can see it, we are at the beginning of a global debt crisis, and the fear is growing that governments will try to erase debt through inflation. So people are desperately exchanging paper money for hard assets like gold. Even though the United States dollar index held up fairly well in the second half of last year, it has been falling steadily since the start of this year. A weaker dollar means stronger buying power for non-dollar buyers, and that injects powerful momentum into gold prices. As long as the money printing machine keeps running, the upward trend in gold will not stop. The second force is that the world is truly unstable. Since the beginning of this year, every major geopolitical event has been like adding fuel to gold's rocket. Let's look at what has been happening recently. The United States forcibly controlling Venezuela's leader, Maduro. What kind of signal is that? It shows America stirring up trouble in Latin America again. And then Trump, over Greenland, even threatened to impose tariffs on European allies. That is basically pushing allies away. Right now, geopolitical fires are breaking out everywhere. In the Middle East, the tension is the highest. United States Central Command confirmed that an aircraft carrier strike group has already moved in. Iran responded strongly, saying anyone who acts will regret it. Hezbollah in Lebanon also made it clear they would not stay out of it. This situation could go south in a heartbeat. On the Russia-Ukraine front, despite talk of negotiations, there are too many wildcards, and no one knows what kind of tricks are happening under the table. Then there is the trade war. The Trump administration raised tariffs on South Korea, increasing reciprocal tariffs from 15% to 25%. This affects massive industries like automobiles and pharmaceuticals. All of this together has sharply pushed up risk-off sentiment. Nobody feels safe. They feel that holding cash is unsafe, holding stocks is risky, and only gold gives them peace of mind. That's why the U.S. dollar index fell 0.43% on Monday, hitting a 4-month low. Everyone is selling dollars and buying gold. The third force is that the big players are buying. Who are the biggest players in the gold market? Central banks. Over the past few years, central banks around the world have been doing one thing: de-dollarization. They've been diversifying foreign reserves and reducing reliance on the U.S. dollar. This has become the fundamental driver for gold's long-term bull market. Central banks buy gold without counting the cost. It's strategic. As long as they keep buying, the floor price of gold keeps rising. And now, it's not just central banks. Private money is coming back too. We see that holdings of physically backed gold ETFs have grown about 20% year over year. What does this mean? It means institutional level money, like big funds and insurance companies, are also allocating to gold. This kind of capital flow is much more stable and persistent than retail sentiment. The fourth force is that stocks are too expensive. Right now, U.S. stocks, especially tech giants, are priced sky high. The S&P 500's CAPE valuation is at 38 times. Over the past 100 years, only the year 2000 during the tech bubble was higher than this. What does this mean? It means stocks are extremely overvalued and could crash at any time. The U.S. stock market is now propped up by a few tech giants. Once these giants can't push the market higher, the index could fall dramatically. On January 20th, the 7 major tech stocks all closed lower, wiping out over $600 billion in one day, and the S&P 500 fell 2.1%. At the same time, smaller and mid-cap stocks fell less. What does this indicate? It shows money is leaving overvalued tech stocks. Where is it going? Bonds carry inflation risk. Real estate has liquidity issues. The best place to go is assets with reasonable valuation and safe haven properties, gold. This is the so-called stock-gold seesaw effect. The fifth and final force is the power of trends. Historical data shows that once a gold bull market starts, it usually lasts a long time and delivers huge gains. Citigroup analysts did a study. Over the past 20 years, if gold rises more than 20% in 1 year, the next year it averages another 15.3% gain. This is trend inertia. Looking at 2024, gold rose 27%. Following this pattern, a big gold rally in 2025 was very likely. And in fact, in 2025, gold surged 65%. Technically, after breaking $4,500, it formed a beautiful breakout pullback rebound pattern. Moving averages were fully aligned bullishly, and volume was increasing. This shows that a large amount of trend-following money is entering the market. So, combining these five forces, currency debasement, interest rate cycle, central bank accumulation, stock overvaluation, and trend inertia, do you think gold has reached its top? I believe $5,000 is not the top at all. It may just be a resting point halfway up the mountain. Most institutions now forecast that if the macro environment doesn't change, over the next 12 months, gold could easily reach $6,000 or even higher. Having covered gold, let's talk about silver, the wild child that everyone both loves and fears. The past couple of days, silver's moves have been truly shocking. Surging and plunging, its volatility has completely spun out of control. Data shows that the current silver market frenzy even surpasses the hype seen in past meme stocks like GameStop. Silver's volatility index briefly hit 124, meaning the market is pricing in roughly 7% daily price swings. For a hard asset like silver, this is unprecedented. From the charts, silver now looks more like a stock being hyped by retail investors than a serious investment. Prices have strayed far from moving averages, and silver ETF trading volumes have hit record highs, showing a flood of panic-driven buying. But behind this madness is historic-level market performance. Bloomberg data shows that this silver bull run has accumulated a return of 520%, completely outpacing any cycle in the past 50 years, like the 70s or the 2000s. This indicates that this silver bull market is not a simple historical repeat, it's a new scale. With silver's extreme swings, the gold-silver ratio dropped to around 46. This usually signals silver is catching up to gold, meaning silver is outperforming gold. But here's a risk you need to watch. According to the latest U.S. Commodity Futures Trading Commission data, some of the largest global institutions have been reducing their silver holdings during this run. They're taking profits. Current positions show that ETF and futures speculators have dropped to the lowest level in 2 years. What does this tell us? It means that the push behind silver's rise is largely coming from retail investors, like people buying silver coins and bars and major Chinese investors. One trend to note is the silver price premium between London and Shanghai. From almost zero in November, it has widened to over $14. This shows strong demand in China, where prices are much higher than the international market. As long as this premium exists, international investors will see London and New York prices as cheap, meaning there's still room to rise. However, Saxo Bank strategists warn that silver may face downside risks in February. Why? Because roughly half of silver is industrial. If prices get too high, factories may look for cheaper substitutes and industrial demand could weaken. Another key point, Chinese Lunar New Year. The Shanghai market will close for a week starting February 16th. Since China is a major buyer, there may be profit-taking pressure before the holiday. However, some argue that this isn't just a normal seasonal fluctuation, it's directly linked to AI production. Building AI factories and making chips require large amounts of silver. As long as the AI story continues, the narrative of silver scarcity can persist. Now, after all this analysis, the biggest question is, what should I do now? In this new phase of massive opportunity and massive risk, your mindset has to evolve. First, let's set the stage. We are likely entering a period of volatile consolidation where the market flushes out the weak hands and takes profits. It's going to be bumpy. If you can't stomach the swings, you're going to have a hard time. But we remain long-term bulls. This isn't the end of the party, it's just the intermission. It's a changing of the guard to clear out the nervous money. To survive this phase, you need to manage your position size. Here are 4 tips. Tip 1. Whatever you do, don't be a perma-bear. This bullish trend is like a high-speed freight train. Don't try to stand in front of it or you'll get flattened. Keep your bias to the long side. If you want to short, keep it tiny and keep it quick. Get in and get out. Don't fight the trend with a big short position. In a mad bull market, the bears are always the first to be sacrificed. Tip 2. Don't guess the top and don't hold in hope. Where is the top? We're in no man's land at all-time highs. There is no resistance. Don't assume that just because it rose too much, it has to fall. The market loves to prove people wrong. Instead of guessing the top, watch the big round numbers. For instance, $5,000, if it holds stable, it's support. If it breaks below, it's resistance. At the same time, you must strictly set stop losses. In this market where moves of tens or hundreds of dollars happen easily, carrying a losing position is gambling with your life. Once you get the direction wrong, you may not even get a chance to recover. Tip 3. Plan for pullbacks, build positions in batches. If you currently have no position and are itching as you watch prices rise, I suggest you hold back. Don't chase the highs. Wait patiently for a pullback opportunity. You need to be like a crocodile, lying by the water, waiting for prey. For gold, the 3 major support levels of 5,000, 4,000, 980, and 4,900 are the best entry points. If the price returns to these levels and stabilizes, buy in boldly. For silver, the $100 mark is a crucial psychological line of defense. If it can get back near 100, that's also a good opportunity. Adopt a strategy of building positions in batches. For example, if you want to buy 10 lots, first buy 2, if it drops buy 3 more, and if it drops again, buy 5. This can effectively lower your costs and reduce risk. Tip 4. Follow up with light positions. Survival is what matters most. The current market volatility is simply too high. Previously, a $10 swing was considered large. Now, it fluctuates 100 inches a day. So if your leverage is high, then at least for the near future, you had better reduce your position size. Keep enough capital to handle sudden fluctuations. If your position is too heavy, a single pullback could wash you out or even liquidate your account. Follow the trend and gradually amplify your gains instead of trying to get rich quick by going all in. In this market, only by surviving do you have a chance. As long as you are still at the table, there is always hope for a comeback. Finally, let's summarize. Gold breaking 5,000 and silver breaking 100 is by no means a simple numbers game. This marks our entry into a brand new financial era. This is an era of currency devaluation, spiraling debt, and geopolitical turmoil. In this era, gold and silver are no longer just investment products. They are the arc of our wealth and the last line of defense protecting the purchasing power of our assets. The target of $6,000 has already entered the mainstream vision of institutions. In 2026, gold is upgrading from an investment option to a strategic necessity. For all asset allocators, this may be the last opportunity to pick up cheap chips in the 5,000 era. Although short-term volatility might make people feel fear, or even torment. But as long as you see the underlying logic of this grand era clearly, you will have the confidence to hold and the courage to ride through the cycle. At the same time, we must maintain reverence for the market. Don't let the frenzy go to your head. Control risk and manage your capital well so that you can have the last laugh in this feast of wealth and turn paper wealth into real gold and silver. Finally, I must remind everyone of the usual disclaimer. All the analysis above is my deep observation based on current market information, news reports, and personal logic. The purpose is to help you organize your thoughts and see the truth behind the fog. This does not constitute any direct trading advice. The market carries risk, and trading requires caution. Everyone's risk tolerance and financial situation are different. You need to act according to your own trading preferences and make independent decisions. Investment is a journey of self-cultivation. Others' views are just for reference, but your own judgment is key. That's all for today. If you find these viewpoints inspiring, or if they helped you clarify this complex market, feel free to leave a comment and let me know your thoughts. Also, don't forget to like, subscribe to Gold Off the Charts, and share the video with others interested in finance. See you in the next video.